I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a man we have not had on in a couple of years. I've tried to get him. He's just so busy. He's flying his plane to his island and stuff like that. But anyway, he's a great guy. One of our favorite interviews here. It's Eric Sprott, chairman of Sprott, Inc. Eric Sprott, thank you for joining us today from Canada.
Well, Greg, always a pleasure. I enjoy the interviews you have, and I look forward to them every week.
I enjoy having you on. I've had John Embry on, he looks like a movie star, John Embry. And he's smart as all anything. I mean, he's a big favorite on the site. But anyway, so are you. And I'm glad to have you on. I just want to reference one of the articles you wrote, and I know you know all about it, even though it was written by a guy named Trey Reich. But it's the relevance of gold in your Sprott's three litmus tests. And this was a chilling line, and I just want to read this. The outlook for gold rests squarely on the mathematics that U.S. GDP can no longer service U.S. debt.
Yeah.
The U.S. GDP, all the money we make, can't service the debt. Will you please explain why that is chilling and frightening, and why it's a good case to have precious metals?
Sure. Well, Greg, you know, it's interesting. I wrote an article, I'm going to say about 3 or 4 years ago, called Surreality Check, Dead Governments Walking. And it was a follow-up to an article I wrote in November of 2007, which is Surreality Check, Dead Companies Walking. And in that particular article about the dead companies, well, the following companies are broke: Fannie, Freddie, Citizens, and General Motors. Of course, they all essentially went broke. And when I wrote the article about 3 years ago with the governments, I was dealing with not just the debt, but it's the entitlements that are by far the bigger issue, where the entitlements, the future value of the entitlements as put out by the U.S. Treasury Department, so this is a valid number, is something like including the debt, is $210 trillion. And I use the simple analogy that if you think of the productive power of an economy, you look at the GDP is $18 trillion. It produces a $500 billion loss. And every year, the unfunded obligations go up by somewhere between $4 and $6 trillion. And the present value of those obligations today is in $80 trillion. And you have to ask yourself, in an $18 trillion engine that's losing $500 million to $1 billion a year, possibly deal with an $80 trillion unfunded present value of the obligation. And I've said in many presentations I've given that the U.S. is broke. We know they're broke. In fact, there was a group of economists led by Professor Koppikoff, who you had on your show, that did this, got 1,000 professors sign up saying to Congress, you've got to deal with this issue, and of course it was immediately ignored. But it's by far the biggest issue, and of course it's not just government, it transcends companies too, and there's pension plans, state pension plans, and all these unfunded obligations where everyone thinks they're going to receive something, only to find out that they're not going to receive it. The latest example was Illinois, where I think they're delaying some pension checks this month as we speak. So the math is pretty simple. The U.S. is broke. And I don't want to single out the U.S. I mean, lots of countries are broke. I'm sure Japan's broke, and various European countries are broke. It's just, we keep extending and pretending and suggesting everything's right, and unfortunately someone's going to pay the price, and I'm not sure when the price will be paid. But the analogy I use, Greg, is that we all knew 10 years ago that Detroit was broke, and 9, and 8, and 7, and finally they went broke. And it was so mathematically certain at the time that you knew it was going to happen. The same will happen in the United States.
Well, you were saying in this article, or the writer of the article, which is your company, so you, saying that the U.S. needs $2 trillion a year on an annual basis to create $2 trillion a year. They're $2 trillion. They need that to keep the economy going.
Right. Well, that's what's happened, that all these governments insist on, well, really, I mean, I take it back to NASDAQ 2000 when we had our crash and the market should have gone through a normal secular bear market. And along comes the government, and they have their cash for sponsors and new home buyer tax credits, and they have parks and helps and conservatorships and whatever, too big to fail, printing, ZERP, NERP. It's all an elongated process of trying to hold it together. Of course, we have food stamps, student loans, all these things that huge impacts in a positive way on the economy, and yet we have almost negligible growth. But in the meantime, all the debts have swollen, whether it's student loans, now you see an article that students can't afford to buy a home, so they're all living with their parents. You have so many people on food stamps, and people taking advantage of the disability fund, for example. There's an interesting example of disability fund. I believe that the latest statement is it goes broke next year. Now, I don't know what they're going to do about it, but, they're paying a lot out in disabilities, and disability people are taking advantage of it, unfortunately. Get shocked that you're disabled and the way you go for the rest of your life. So it's symptomatic of one of the problems.
How long can we keep creating fresh $2 trillion of credit? A fresh dump of credit of $2 trillion every year. How long can that go on for?
Well, we're at an interesting time right now, Greg, because when you look at the U.S. Treasury market, and I don't pretend to be an expert in the U.S. Treasury market, but I can look at macro factors like anyone else can. The biggest buyer of Treasury used to be China. China is the biggest seller of U.S. Treasury. Russia is the seller of U.S. Treasury. The Middle East must be a seller of U.S. Treasury. For all we know, the Norwegian pension plan might be a seller of U.S. Treasuries because they're all becoming underfunded. So you have all these sellers selling it, and it's no wonder to me that yields have been creeping up here, and we're now over 3% on the 30-year bond because there's probably more buyers than sellers. I'm sure somehow the Fed is surreptitiously either buying it or arranging for it to be purchased, maybe, by lending the banks all that free money they can buy up the treasuries. But that market is the size of the change between China that was buying whatever, 400 billion and sell 200 billion. You just take rates to be at 10%. Just take one dynamic, let alone the Russians blowing out their bonds and the Middle East having to sell it, and maybe other emerging markets that are having huge problems when you go to Brazil or Argentina. I'm sure when Venezuela, for example, if decides they have to sell their gold, believe me, they've sold their U.S. treasuries a long time ago. Gold's the last thing to go.
Well, are you surprised at how long they have? This has caught a lot of people. I mean, good people. Paul Craig Roberts, the former Assistant Treasury Secretary, thought that this would have been blown up a long time ago. He said that in an interview. Many other people, money managers, people who manages lots of money like you manage your companies underneath your umbrella, billions of dollars. I mean, you were calling for this a few years ago. And a lot of people thought this under normal metrics would have folded. That we would have had the inflection point, but we haven't. Why do you suppose that is? Is it the fraud? Is it the lying, the phony accounting, the money printing? What has kept this thing all afloat?
Well, I think what's kept it afloat, if you wanted a real reality check, I think the fact that interest rates are at zero lets people buy homes who can't afford homes, much like the 07 or 08 situation. It lets people buy cars that can't buy cars. So with cars and houses are huge expenditure items, and you bring that buying forward. And those have been the two areas of the economy that have shown some resilience, if not outright strength, for example, because interest rates are so low. But there's an end to that, Greg, when we find out that the default rates on loans start going up, when people who really shouldn't have been able to buy it could buy it, just as we went through housing prices, subprime prices, and it looks like we're going to have a subprime crisis in auto here. So these government measures that have been quite overt, whether it starts with, the cash responses back in the early 2000s, the new home buyer tax credits, the college also the various student loans, the food stamp. These are all things that have held it together. And I'll tell you, it would look a lot different if the government was not as actively involved in it. Because by making autos and homes economic for people, in a way the government can say they're not in it, but they're in it because they're allowing these rates to be where they are in order to cement this buying that someday, I know they're talking about going to negative interest rates. I can hardly even imagine it, actually. I just can't imagine completely go to negative interest rates where the more of the mortgage gets paid, the more of the mortgage, but we're in a kind of surreal world. But that's what kept it together. But there's lots of signs of weakness.
Which brings me to Janet Yellen talking about interest rates. 1 minute she says that a rate increase in December is, what did she say, live? It's live. Well, I don't know what that means. I guess it's a possibility. And then in the same time, they're floating trial balloons about, like you were talking about, negative interest rates. I'm thinking that I'm in some kind of a surreal Fed cartoon. That some bizarro world of it is, but it's not. We're saying yes, but we're saying no. We're saying no, but we're saying yes. What is your read on Janet Yellen? What's she trying to do? And isn't she going to look pretty stupid if she doesn't raise rates in December?
You're getting the rope-a-dope. One minute you think one thing, the next minute you think the other. Now, I happen to read the last FOMC statement. I mean, I take it with a pretty soft indication that they were going to raise rates in December because they did, of course, use the same thing, data dependent. The only thing they put in the minute is that we're going to consider it for sure at the December meeting. But then you come along, and as you point out in some presentation, I guess it was a presentation to Congress yesterday, that you mentioned, well, if the data doesn't confirm, we might have to consider negative interest rates. And, I have a tough time believing that rates are going to go up, but one of the things that all central banks are doing is I think they're losing credibility, that people really believe they know what they're doing. We saw what happened in Japan the last 25 years. We see what's happening in Europe. We see what's happening in the United States. I mean, the economic growth, there is growth, is so anemic for the money that we spend and the availability of money due to low interest rates for people to spend, but still anemic, and I believe getting worse as this year progresses. And there's lots of signs of that.
I'll move on to gold. I mean, I remember the first time I heard that, I know this is in 2010, it was at the CFTC meeting, and gold's leveraged to 100 to 1. And I thought, 100 to 1, oh my gosh. And then we found out a year or 2 years ago, it was 200 to 1. And now we find out it's nearly 300 to 1, 300 paper ounces to every 1 ounce of gold, basically, at COMEX. Is that even a market? What is that?
Yeah. Well, Greg, I got to tell you, I mean, I find what's happened here in the last, let's call it 6 or 8 weeks, almost disgusting. Because legitimately, a great number of new investors came into the gold market. And I would have ventured to say they might have bought 150,000 contracts, but something of that order, which is equivalent of 15 million ounces of gold. And I can tell you that every ounce that was bought by these new players was a naked short by a commercial banker. The data just shows that. And those of us who look at it, even though we never like to believe it, we've seen this story before. The commercials suck everyone in, they buy gold, and then the commercials end up with a huge short position, and then they just pound it down. And even, for example, Greg, when we look at what happened when the headline came out that Yellen might go to NERP, you might think gold would go up, right? No, gold went down. And it's because there isn't a gold market. There's a market that some commercial bankers have control of, and they take the market wherever they want to take it. There's no regulation. There's no enforcement of position limits in my mind, none whatsoever. And they can just rule the market. And it's not just the COMEX that they rule. It's, of course, all the options around those markets where there are also players writing the options, and they make sure everyone loses money on the options as well. So it's basically going to the casino and getting skinned every time. And it's with a great regularity. And as you mentioned, we're down to something like 5 tons of gold around the COMEX. And there's like, 2,500 tons of claims against the 5 tons. I mean, 5 tons is not a lot of gold. I mean, there's so many, it's $150 million, okay? There's a lot of institutions that could buy 5 tons of gold. I wish they'd quit buying the futures contracts and just buy the gold and let's see what happens. So it's a very important thing to watch. I've always been a great believer that the central banks' gold reserves they're running on fumes. That the U.S. has, in my mind, for sure sold gold. We see export numbers that show us that. I've always thought that the gold demand is always at least 2,000 tons more a year than supply, and government's only had about 18,000 tons of gold that was available for sale as much as 10 years ago. So I got to think there's not much left there. I think the rate under GLD back in 13 was orchestrated to get tonnage out of GLD. I think they stripped something like 700 demand data is strong. We even have China finally announcing every month that they buy an extra 15 tons. Well, that was never in any of the data before. So now we have a buyer who now buys 5% of the market. That, as far as the experts in the business, but they're the mainstream experts, they never counted China as a buyer of 5% of the gold market. Now they have to count it as 5% of the gold market. But I will bet my bottom dollar, when we see the statistics at the end of the year, they'll say demand equals supply. Even though we got a whole new entrant here that was never reported before. Plus, we got Russia's a big buyer. We have other central banks that are buying, and there's been some investment demand come in as well. So I still believe strongly goes more to the thesis that the U.S. is broke and other governments are broke, and ultimately if they're broke, you don't want to have your money in the bank.
You are a holder of gold and physical gold and silver, correct? Your company?
Yes.
How long can they do this? I mean, even a couple of years ago, you were saying they were running on fumes. Well, I don't know if they took money out of Ukraine or if part of that was taken out of Libya or, there's escapades around the globe. And I don't know how they're getting, maybe they have some secret stash or something like that. But how long can they do this? I mean, what would you tell holders of gold and silver? I hear people all the time saying, well, I bought in, 11 or 12 or 10 and I feel screwed and I feel whatever. What would you tell people that say, wow, it's been a 4-year drought in silver and gold, and they bought it much higher? What would you say to them?
Well, I mean, I'm pretty certain I know what happened in 13. That it was like a 7 sigma event when gold went down, which means it happens once every 300 million years or something. It was so obtuse. And the bottom line was to raise the GLD and get to 700 or 800,000 tons that they were short, and that got them through 13. It kind of cooled off the demand in 14 because everyone's looking at something that's going down, and it's probably kept demand a little modest this year because gold's essentially gone nowhere. It hasn't gone up much or down much, really, but it keeps everyone calm. But we have seen bouts where, people come in to the U.S., come in and buy all sorts of gold and all sorts of silver. There's a shortage of silver this year. The demand for silver out of India is almost astronomical. I mean, I can hardly believe they're able to import what they're importing. They just import 2,000 tons a year. 3 years ago, this is in about a 27,000 ton market, and they now import 10,000 tons. So
of silver.
One person comes in and buys an extra 8,000 tons of the 27,000 ton market, and the price goes down. Hard to imagine. But the price is determined in the paper market, unfortunately.
You're talking about silver here.
I'm talking about silver now, yeah. But the same is true of gold, and I think, there's way more demand for gold than there is supply. But the paper guys run the market. We can see that with the antics that have gone on this month. It's all paper buyers, paper sellers, and paper sellers overwhelm the paper buyers. And there's hardly any gold moves around. Now, I think that may change to a new exchange likely to start up that will be physical gold only. And I think that could make a big difference. I hope that if and when that market opens, it will take the business from COMEX because it's just not an appropriate place to trade.
You think the prices, can you make a call on the prices of gold and silver going in? David Stockman, incidentally, you brought up David Stockman in the pre-interview. He doesn't like gold now. He likes it later. He thinks there's going to be before the next election cycle, and I hope I'm getting his words correct, that the whole thing will unwind anytime between now and the November election. And he thinks gold and silver will go much lower. What do you say about that?
Well, I mean, that's his view. Who knows when the thing's going to fall apart? You've already commented. I would have imagined it would have fallen apart long ago. And I would have imagined that the people playing the markets, they're just baiting the Fed, right? They just use the excuse that the Fed's going to reduce rates and therefore you got to buy stocks. But ultimately, when the sharper minds determine that, hey, there's been no spillover of the economy here and the economy's sinking, then, of course, the markets are going to have a tough time going up, unless, of course, somehow the government, the Fed, the commercial banks have found a way to support the market. There's very, very little volume now compared to a few years ago, so it takes less and less money to support it. I don't lose any sleep over the price of gold going down in the sense that I believe what I believe in. So I believe that it's been manipulated. It's very much of a Ponzi economic scheme, the whole Keynesian thing, we're going to spend money and print money, it's all going to work. It's not working. So I don't think I want to wait to find out the day when it falls apart. Because if it falls apart one day, it'll be too late. So, for example, let's say there was a failure on Comex on Tuesday of next week. Are we going to wait for the next election, or, do we just go with our gut and say, well, you can see what's happening here. I want to be positioned beforehand. I can remember shorting stocks before March 7, 2000, and it was a bit of a rough ride for 3 months. But my God, when it rolled over, they just disappeared. You have to be a little bit early on things. Not that, I believe the last 4 years have been orderly and created to be difficult. I think gold would have gone up because they couldn't stand it going up because they were going to start printing money. And if you're printing money and gold's going up, everyone figures it out. So every time you think gold should go up, it typically goes down. And even times when, when we have the FOMC statement, I can't even believe that people in purpose that we're going to get a rate increase, because that isn't what the statement said whatsoever. If you really want to read it. But that's what the mainstream media wanted to pick up on. And I find it kind of funny the stock market goes up, but gold goes down, all because they're going to tighten it. It's just so ridiculous, the different phases of what happens. But the favorite vehicle stocks, and then favorite vehicle gold. So I've been around a while. I have the patience to hang in there. I've been a buyer of gold stocks this year. So I'm still very hopeful that it will end up as being a very, very rewarding trade.
Everybody I talk to, David Stockman, no matter who it is, Harry Dent, David Stockman, you, I don't know, we're headed for a collapse, correct? Bigger than '08?
Has to be a collapse. Yes, way bigger than '08. It's kind of funny that the debt's exploded. We had a debt problem in '07, '08, and the debt's exploded. Yeah, and debt, one of the things about debt allows you to consume things. The more debt you take on, you're bringing forward consumption. Well, that bringing forward of consumption helps the economy. When all of a sudden rates start poking up here, and you can't bring the new buyer into the house market, and let's, for example, think that prices of houses stay, well, then the whole thing stops because it was artificial in the first instance. Rates are not normal today. That's probably the biggest thing. I would always, when I give a presentation, I just say to people, if you think printing money and zero interest rates are normal, if you do, just keep buying stock. If you don't believe it's normal, do something about it.
There's no way they could normalize rates at this point. No way.
Of course not. Of course not. Imagine the carnage. What would the value of houses, what would car sales do if it was 6% down, 6% a month versus 0 and 0? It would be hopeless. Price of a car would double.
And I just want to get your thoughts on this. This is a quote from Charles Hugh Smith, and he says, and I just saw this this past week, collapse begins when real reform is impossible. Is real reform possible? Can they fix? They just passed they basically removed the debt ceiling. They passed a huge budget with even more spending. Is real reform possible? And if it's not, is Charles Hugh Smith right that collapse began when real reform is impossible?
Yeah. Well, I suppose some reform is possible, but Greg, not without having to go through horrible events in financial markets and economic markets. There's just no way that we can transition from a printing and spending environment to a non-printing, normal interest rate. Nobody spends. You'd believe that weakness begets weakness. And the only way you can stop the weakness is using fiscal or monetary policy. Well, if you use your monetary policy tools and you have no room in the fiscal side, there's going to be nothing stopping you. The dominoes would start to fall. So, yes, there could be some reform in the sense that, let's say we decide that the whole system is wrong within the Federal Reserve. But, Greg, that could take 10 or 20 years to figure out. But in the meantime, financial markets would have a horrendous decline.
You think a collapse is baked into the system? You think that the powers that be know that we're going to have a collapse and there's no way of getting around it? Do you think they know? Do they think they actually could save the system by what they're doing?
No. And here's one of the things, when people ask me, what might cause the collapse sooner than one might think, and I try to go to real economics. First of all, as many of your guests have said, the inflation rate is massively understated. Just the healthcare premium. would cause people's inflation rate to be 2%, let alone the cost of education, food, and whatever else. Okay? And as this healthcare thing becomes a greater and greater burden, which everything I read, we hear about double-digit rate increases every year. Some of them are stunningly large, 50, 40, 100. Who could afford a 100% increase in their medical premium? And it's just working through the system now. And of course, the more that you have inflation with no wage growth, your discretionary spending must go down. And save for zero interest rates, which lets you buy a car because someone else funded it for you, other things being equal, your spending must go down. And I just see inflation as eroding people's buying power. And that's why I think a lot of these economic numbers they see are incredibly weak these days. I think of things like transportation, electricity, consumption, things like that are, as state tax receipts look like they're going down now. Does it make sense if we have a strong economy and state tax receipts are going down? It doesn't to me. And it's been a wonderful barometer, by the way. When state tax receipts go down, you're going into a recession.
Eric Sprott, he is the chairman of Sprott, Inc. Eric Sprott, good to have you back on after a year and a half or so. Really appreciate having you on. Eric Sprott up in Canada, thank you so much for joining us today on USAWatchdog.com.
Hey, Greg, my pleasure. All of it to you.